Michael Saylor spent 5 years building an identity around one rule: never sell Bitcoin. Not for liquidity, not for dividends, not for anything. On June 1, Strategy filed an 8K disclosing it sold 32 Bitcoin between May 26th and May 31st. The proceeds? Approximately $2.5 million. The average sale price? $77,135 per coin. For a company holding 843,706 Bitcoin worth roughly $62 billion, that is 0.004% of the stack. The number is almost comically small. That is not the point. The symbolic break mattered more than the arithmetic. Saylor built a market psychology around certainty. Institutional buyers, retail holders, and leveraged funds all priced MSTR on the assumption that Saylor would never flip from buyer to seller. When that assumption broke, the repricing was immediate. MSTR fell over 6% on Monday. Bitcoin dropped 3.7% to $69,300, its lowest level in nearly 2 months. Here is what the consensus read missed. The 32 BTC sale was not a one-off. It was the first visible signal that Strategy is now managing a capital stack under stress. Strategy carries approximately $13.5 billion in total preferred equity obligations. Annual dividend burden runs roughly $1.2 to $1.4 billion. Cash reserves stood at $871 million. At that rate, without new STRC preferred stock issuance, the company has less than 9 months of dividend coverage on hand. The STRC preferred stock, launched in 2025, now carries an 11.5% annual yield, up from 9% at launch after 7 consecutive monthly rate hikes. Strategy raised $3.2 billion through STRC in April alone. Monthly dividend obligations on those shares, $80 to $90 million. The math works as long as 2 conditions hold. STRC investors keep showing up at full price, and Bitcoin does not fall below the level where Strategy's MNAV ratio drops under 1.22x. Strategy itself disclosed that rule. When market cap falls below 1.22x Bitcoin holdings, the company switches from issuer to seller. At the time of writing, the MNAV is hovering around 1.23x, 1 bad week away from the trigger. CEO Peng Lei put the new philosophy plainly: I believe in math over ideology. The ideology was the product. The math is now showing its limits.
Most coverage focused on MSTR. The more actionable read for listed equities sits with Coinbase. Coin dropped 5% on the same day, from a Friday close of $189.03 to around $179.50. That transmission is not coincidental. Coinbase revenue is directly tied to crypto trading volumes. When BTC falls and sentiment turns defensive, retail trading volumes compress and exchange revenue follows. Here is the less obvious layer. Compass Point analysts issued a sell rating on Coin this week with a price target of $140. Their argument, Coinbase's push into derivatives via its $2.9 billion acquisition of Deribit, is walking into a crowded and quickly commoditizing space. Coinbase pulled in $50 million in first quarter perpetual futures revenue, but retail spot trading fell to its lowest level since the third quarter of 2024 in the same period. That is a sign of cannibalization, not expansion. The derivatives business is pulling revenue from the spot desk. Meanwhile, the competitive field is expanding fast. Kalshi just received CFTC clearance to offer Bitcoin perpetual futures. CME announced around-the-clock Bitcoin futures and options. Kraken and Robinhood are both rolling out perp products. And Compass Point raised the most uncomfortable point. Binance's potential re-entry into the U.S. market, accelerated by political ties, is a growing risk that limits Coin's pricing power on the most profitable trades. So Coin faces a two-sided squeeze this week. On the top line, BTC below 70K suppresses retail volume. On the structural side, the derivatives moat is eroding before the revenue has scaled. The $140 Compass Point target implies roughly 25% further downside from current levels. TD Cowen still has a $400 target, unchanged. The spread between those two targets tells the whole story. One camp reads Coinbase as a regulated gateway to an expanding asset class with no credible substitute. The other reads it as a toll road where the toll gates are being torn down one by one. Which read is right depends almost entirely on whether BTC finds a floor in the next few sessions.
By Tuesday, Bitcoin had fallen to $66,614, down over 6% from the session high. Total crypto liquidations hit approximately $1.25 billion in a 24-hour window, according to CoinGlass data. That number does not happen from one seller. It requires a convergence. Three distinct forces stacked this week in a way that magnified each other. First, the Strategy 8K filing, disclosed June 1st, confirmed the first BTC sale since December 2022. The scale was trivial. The signal was not. The market repriced the assumption that Saylor is unconditional demand. Second, U.S. spot Bitcoin ETFs recorded outflows of 62,794 BTC over the prior 3 weeks, the second largest outflow streak on record. The 11-day outflow streak was the longest since spot BTC ETFs launched. A single session saw $484 million in redemptions. Bloomberg Intelligence pushed back on the panic, noting that cumulative net flows since launch remain near $57 billion. But the direction matters as much as the level. 11 consecutive days of institutional outflows into a Saylor sale creates a one-way flow signal. Third, on Tuesday, Mt. Gox moved approximately $739 million in Bitcoin from cold wallets, the estate's first on-chain movement in over 2 months. The defunct Japanese exchange, which collapsed in 2014, has been repaying creditors since 2024. The repayment deadline for remaining creditors is October 31, 2026. Every wallet movement by Mt. Gox raises the same question: how much of this supply gets sold? Creditors who receive their Bitcoin back have historically sold. The estate still holds thousands of BTC. Against that backdrop, leveraged long positions in derivatives markets found no defense. Elevated open interest in derivatives amplified the move. When price broke below key technical support, the cascade of forced liquidations added momentum. One analyst noted that an insane amount of spot selling could push BTC to the low 60Ks or even mid 50Ks. Kalshi prediction markets reflected rising expectations of lower BTC prices in coming months. The important structural observation: Saylor's sale was the trigger, but ETF outflows and Kalshi created the kindling. The trigger only needed to be small.
The most analytically rich signal this week did not come from the BTC price chart. It came from Standard Chartered. Jeffrey Kendrick, the bank's head of digital asset research, issued a note arguing that Strategy's sale marks the beginning of ETH outperformance over BTC. His price ratio target? The ETH-BTC ratio rising to 0.04 by year-end, from approximately 0.028 currently. That implies Ethereum outperforms Bitcoin by more than 40%, even if both assets move in the same direction. The reasoning is structural, not speculative. Bitcoin does not generate yield. Ethereum can be staked at approximately 3% annualized. Bitcoin treasury companies like Strategy must occasionally sell holdings or raise new capital to fund operating obligations. Ethereum treasury companies, like Tom Lee's BitMine, the largest ETH treasury, can generate staking income without liquidating assets. That yield difference becomes a capital structure difference, and a capital structure difference becomes a pressure difference. Strategy's MNAV trigger rule, its rising STRC dividend rate, its $871 million cash reserve against $1.2 billion in annual obligations, these are Bitcoin-specific structural constraints. ETH stakers do not face the same binary. Yield income removes the forced selling scenario. Here is why this matters for Coinbase holders. Coin's revenue mix is heavily BTC correlated. If Kendrick's rotation thesis is correct and ETH outperforms meaningfully, Coinbase would still benefit from ETH volume. But the platform's heaviest revenue weight sits with BTC retail activity, which is the segment most directly damaged by a BTC price floor breakdown. The forward checkpoint is clear. BTC's 200-day moving average and the 67K to 70K zone are the levels every analyst is watching. Saylor himself signaled the next buy window is approaching. Bitcoin only needs to grow 2.3% annually to cover Strategy's dividend obligations indefinitely. At 67K, BTC is down 47% from its all-time high near $126,000. Saylor once said Bitcoin would trade closer to $40,000 to $50,000 without Strategy's sustained buying. The question now is whether Strategy can resume buying fast enough to restore the psychology it broke this week. Until that answer is visible, in the form of a new MSTR purchase announcement or a stabilization in ETF flows, coin holders are sitting in the most direct exposure window to that unresolved question. The hook is still open, 32 coins sold.
The question is what comes next. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.